Welcome to Chew the Fat. In this series, I sit down with high-performance guests and we talk about life, business, and what it takes to be at the top. This is part of my mission to raise $1 million for charity by writing a cookbook called Eat with Purpose. But I'm going to need your help. If you can share the content and leave a review, it's going to make a massive impact. And the bigger the audience, the greater the reach, and the sooner we can get to that $1 million goal. Enjoy the episode. Jeff Ransdell, founding partner and managing director of Fuel Venture Capital. Welcome to Chew the Fat.
Well, thank you. Welcome to Miami.
It's a beautiful day. I'm not surprised. It's an absolutely incredible place. We're loving it so far.
Yeah, it's the greatest city in the world, in my opinion.
So where I'd love to start is what's the context in your childhood that made you the person you are today?
Well, that is a really good question. Nobody's really ever asked me that question. So I think it's really two things. I think about this quite often, to be very frank. I grew up around a lot of very, very strong men. Mm-hmm. I grew up on a ranch in southeastern Colorado, where, if you weren't up at 6 o'clock in the morning to do your chores and make sure that the livestock were taken care of, you'd get a bucket of water thrown on you, and then you were responsible later in the day of cleaning all that up. My father was an accomplished athlete. So I was the firstborn, and so I kind of grew up in an era where sports was very focused on. Not like today where the academic, I think, sometimes is much more focused on than the athletic part in today's world. But I kind of grew up where it was just the opposite, and so we lived in Colorado. My father was told by a hockey coach that I had some skills, and so the decision was, well, I'm never going to be able to really get to where I wanted to go, in Colorado. So we moved to Minnesota, just south of the Canadian border, which is considered Hockey Town, USA, and so being I guess playing sports at that kind of level. It requires a tremendous amount of discipline, a tremendous amount of sacrifice. My father wouldn't let me, I wasn't allowed to date girls and stuff like that. I wasn't allowed to be out, past certain hours because I had to be up in the morning, and my dad didn't want me to lose my focus. So, the girl thing was always kind of set aside. And so I think that the discipline definitely came both from, the ranch, which there was, you work 6 days a week. You got Sundays off, and there was always something to do. And again, the men that I grew up with were just extremely, just hard leatherback kind of people, and that's what I grew up with. And so, when my athletic career ended, I just had a whole bunch of time on my hands, and I was always a workout person. So I was working out at a gym. And the guy who owned the gym just wasn't wasn't a very good business person and wasn't doing very well. So I went to the bank and I worked a deal out with the bank to take over the club and just make the bank payments. And I think, I know the bank at the time was like, what the hell do we have to lose, right? We're not in the business of owning, gym equipment. And so just let this kid, go. Well, that ended up turning into a very successful business where I was rolling up health clubs. And,
wow.
I'm going to age myself here, but, in the early 90s, that's what I was doing. In the early 90s, there was, especially in the Midwest, there was people who were quitting their jobs, and starting these health clubs, but they didn't really know anything about business. They loved working out and being healthy, but there's a big difference between working out, being healthy, and actually being able to run a business. And so that's what we did. We started off, we would go into these cities and we'd find out, who the players were, and then we would knock on the door and we were just rolling it up.
Wow.
And then we would change the facade and we would change the interior, and I'd build a sales team and we would turn it around, and we did that. And then I started a clothing company that was
in parallel,
yeah. Which was all athletic wear. So like shirts, pants, honestly, the shirts or the outfits that most women wear today, the tight,
yeah.
We started that whole trend. Incredible. Back in the early 90s. And then And then I also I had a sound and light production company. And so I was very entrepreneurial.
Yeah.
Three businesses. And then, I ended up selling those companies and taking a job at Merrill Lynch. And then I was there for 21 years. Never thought I was going to be there for a year.
Yeah. What was that shift like for you going from, running your own businesses and rolling up companies to then, working in a corporate business?
Yeah, so I think if you actually talk to anybody that knew me, at Merrill Lynch, I was that weird dude that didn't kind of ever really fit into the corporate norms. And in fact, it was something, I used to say to people all the time, right? I didn't want to talk like all the people that I was surrounded with who were much older than me. I didn't want to think like they did because I felt like I needed to be on the, cutting edge. I needed to be thinking about, getting on my horse and riding out into the future and then coming back and working with that in mind. And I didn't want to look like them. So I didn't dress like them. I didn't act like them. And in the early days, that was a real problem, because in corporate America, they kind of want you to be like everybody else. And at Merrill Lynch back in those days, it was almost like a uniform. Everyone wore the same, $1,000 blue suit with a, pocket square and cufflinks, and it was kind of a uniform. And I always tried to do something a little bit more edgy. So it was definitely, it was difficult, but the really cool thing is the leaders that I worked with at Merrill, and I was really fortunate to work under some of the most legendary people on Wall Street, and that's a fact. And I think real leaders understand how to develop people. That's one of the things that they're gifted with, and understanding how people act and do things differently. And the people that mentored me understood I was a little different and let me do what I felt I needed to do, and it worked out really well for everybody. I always like to use the analogy of Dennis Rodman and the coach for
yes. I don't have his name off the top of my head. If only we had a Jamie here in the podcast studio.
Yeah. Anyway, the point was that that particular coach, and his name will come to me in just a second. Can't believe I can't think of it, but realized that he was a very difficult person to manage, but it was just because he was different, and so he fed that and let that guy, and it worked off obviously very well. The Bulls were, and the Lakers, they all had incredible, track records.
Yeah, and what was really interesting is that as you share that, and a lot of people who've been listening is either early stage starting a business or in corporate looking to make that shift. It's really interesting to hear you talk about you've done multiple successful businesses, then you've gone into the corporate world, and I think the important learning lesson there for a lot of people is, it's what you can potentially learn from having those right people around you that then, of course, it would shape that next stage. There's having those leaders around you. And then that key point you touched on there, which is like, people are unique. And so finding how to work within their confines, those will often be, the bright shining stars who can then push things forward, and it becomes almost the new uniform in the future, if that makes sense.
Yeah, I think, it's interesting. And I say this to people all the time because they always kind of, I have taken a little bit of an odd path, right? I was a founder, went into corporate America, which was completely different. And then I left again and came back into the creative economy. But my opinion of all of that, and what I like to tell people is it's a long game. And when you're young, you don't really realize how long of a game it is. So let me give you an example of what I mean. If you think about a professional athlete, again, I tend to go back to sport quite a bit, but a professional athlete's career on average, depending on the sport, but it's usually around, if you're lucky, 6 to 7 years. That is the career lifetime of a professional athlete. Now, also think that which isn't very long in my opinion. Okay, so then you have on season, right, and you have your off season, right. So if we talk about the NBA, right, when the NBA season's off, they have the whole summer to recover, to practice, to get better, to get leaner, to get better. There's an off season to focus. But in corporate America, right, which is all of us, our careers can go 30, 40 years, and maybe even longer with technology. It's going to continue to get longer and longer, right? And as far as recovery, depending on the type of person you are, but, I started Fuel Venture Capital 7 years ago. I think I've taken 2 weeks off in total for that 7 years. And when I was at Merrill, I'm not sure that I ever actually took more than 2 weeks off in 21 years.
Wow.
So where I'm trying to go with that is it's a long game, and you have to be mentally prepared for it. You have to be physically prepared for it. I mean, the worst damn thing you can do is let yourself get out of shape, and then you can't compete, right? How are you able to compete at that kind of level for that long of time if you're not eating right, taking care of yourself, et cetera? So I really view it as being a corporate athlete, right? So if you have that kind of an understanding of a fundamental foundation, well, then what I think you really have to think about is where do I put myself? Again, like I said, get on your horse and ride out into the future. 10 years from now, what do you see yourself doing? Where do you see yourself living? What kind of car are you driving? What kind of house are you living in? What does your wife look like? Do you have kids? Do you not have kids? Do you have a yacht? Just spend a little bit of time dreaming, right? You can't make a dream come true unless you start dreaming. And so, right out there, ask yourself all those questions and then come back to the present and start living with the end in mind. And then you have to ask yourself, well, how do I position myself in the best way to ultimately make that come together? And that's what I did, right? Did I really expect that I was going to spend 21 years in corporate America? The answer is no. But what happened is every single year I realized I was getting introduced to another mentor or another person who was just brilliant that for whatever reason put their arm around me, and I got to learn from them.
That's incredible.
So to me, it was like all these things that I'm doing, eventually when I decide to go do my own thing again, it doesn't matter what is presented to me. I've been there many, many times, and I'll brilliantly execute, and I'll be able to be successful. And so that's how I did it, right? And it just got to a point where I was looking myself in that mirror every single morning and saying, I think it's time. I think that the industry that I was in was starting to fade, right? And the whole financial services. I mean, you and I need to sit down with a financial advisor and buy Apple stock, like we need someone to make us run a marathon, right? We can do it on our phone through a number of different and not have to pay a damn thing, right? So I knew that was coming. And so, I also realized that the public markets were shrinking, and they had been shrinking for quite some time. And that, real wealthy people and global families, when I sat down with them and talked to them, they all said the same thing to me, right? It's like, Jeff, here's what I expect from you. I expect you to get me invited to very, very difficult tables to be invited to. I want to own Uber long before it gets to the dilutive markets, and that's your job, to get me invited to that table. And so, I sat down with my bosses. I'll leave their names out because it doesn't matter. But I sat down with my bosses, and to their credit, they run a very big bank, and that's what they do. And they agreed with me, but there wasn't going to be a shift in strategy. And so I just decided to, it was time to, stop talking about it. You tell everybody to take risks. You tell everybody to do exactly. So it's time to, I hear what you're saying. I see what you do. So I decided to do it.
Incredible. And when you made that jump, what did that look like for you? Did you have to go and raise capital to start? The venture capital is a private. How did that look?
Yeah, another good questions. So I was fortunate enough. I had made some good investments in the private world that had exited and created some liquidity for me. And again, I was one of 6 people that ran the largest financial institution in the world. So I'm not going to lie to you. I got shot up pretty well with opium every year in the form of bonuses and whatnot, which was one of the reasons why it was hard to walk away from.
Of course.
Not to joke around. So I started Fuel Venture Capital with my own capital.
Awesome.
So I took a large chunk of my savings and I started the firm, and then I started really leveraging my Rolodex.
Yes.
Our first fund, our flagship fund 1, was a $162 million fund. We quickly, about 6 months after we closed that one, we started another one, which was called FinTech Growth Fund, which was specific to fintech companies, which our institutional investors wanted us to do. That was $100 million. We have an opportunity fund that's kind of open-ended, and it's all of our just opportunistic things that we allow our investors to do. That's probably sitting at about $150 million now. And then our new flagship fund is a $200 million asset. So we're sitting, I don't know, a little over $700 million, not quite 7 years into it yet.
Incredible. Love hearing those numbers. That's very cool. And tell me, like, what is it that keeps you ahead of the pack when it comes to the investment side of things, when choosing the companies?
Well, so that's actually, I think, one of the differentiating factors between venture capitalists, right? I mean, and to give the credit to your Andreessen Horowitz of the world, who have been around for a really long time. Sequoia has been around for a really long time. Benchmark, which happens to be my favorite. If those guys want to be on your cap table, all they have to do is make a phone call, and they're going to be on the cap table, right? Eventually, if we keep doing what we're doing, I dream and strive to be in a position like that. That's not the case right now, though, right? So we have to work at it. We have to sit down, and we have to have a conversation with the founder about our value proposition, what we can bring to the table. And I think we bring some very interesting things to founders. I really do. I come from Wall Street, and it's not a big place. If you don't understand that, there's not an investment banking or an investment bank out there, mid-market or large market, that I don't have personal relationships with, or I'll even take it one step further, that I didn't work for them or they didn't work for me in the last 30 some years,
which is huge.
Right?
Those connections, above and beyond that initial capital, just being able to make the right phone calls to make the right connections is incredible.
Well, step. and that's one of our edges, right? So if you're a founder, I mean, you're building a company to do one of two things: to either monetize by selling it to a bigger company, or to monetize it by selling it to the public. And if you're in Sydney, Australia, and you're building a company and you want to take it public, you can't take it public in Australia because you don't have a capital markets to do it.
Yeah.
So you're going to want to bring it to the U.S. And that's that's really one of our edges, that we don't necessarily. It's not that we don't focus on Silicon Valley. It's not like we have an issue with that. But there's just so many, I just listed a whole bunch of people or firms that are really, really well known at what they do that are there. So why would I think that I can compete with them? I can't. I know that. So I'm going to go throughout the rest of the world, right? So, I was in Sydney last summer. Well, I'm going to tell you right now, there's none of those firms that I just talked about have ever gone to Sydney, right? And they're not going to, because they don't need to. But I will, and I'll find a company in Sydney that is doing incredible things and can really leverage and benefit from knowing us, because we'll bring them, like YBot, right? I mean, YBot is in Miami, right? And it's here for a reason. And a lot of the technology is still back in Sydney, but they've got boots on the ground here, connected with us, and eventually we're going to sell that company to a larger U.S. company, or we'll take that company public. Period. Into discussion, and we have the connectivity to really put those dots and connect those dots together, and I think that makes us very different. We're also very involved, right? There's nothing really passive about us, and I make that very clear to our founders. I've got zero interest just giving founders money. I mean, that's just not. First of all, I have a responsibility to my investors, and I don't think that my investors would take kindly to me just taking their money and throwing it up on a wall and hoping every morning that something works out. Kind of a bullshit way of managing other people's money. So we're very, very involved, and but I will tell you this, my friend, and if I'd have known this, I still would have done the same thing, because I love what I do. But I had 280 billion of entrusted assets that I was ultimately responsible for. I had 5,000 employees, traveling back and forth between Miami and New York every week. I thought that was a really stressful job. But it was nothing compared to what I do today. I mean, this is 7 days a week. It's 110, 120 hours a week. Never, like last night, Maggie, my partner, and I were up till 2 a.m. doing models for a Zoom call with investors today at 10 a.m.
Wow.
And it never stops.
There's so many angles I want to go, but I want to start with a question I have, and it's probably a selfish one, is knowing, the tech hub that America is, and like all of these amazing unicorns that are coming from it. What's your perception of Australia from a tech standpoint, from what you've seen so far?
Yeah, so I actually have a pretty interesting thesis that I'm developing on this, and I'll share it with you. And again, there's a lot of there's not a lot of proof source data from what I'm about to say, but we're working on it. So go back to those big name firms that I was talking about in Silicon Valley, and then think that you are. And again, this isn't about being disparaging to any founder who's building in Silicon Valley. It's not my point.
Yeah.
But my point is if you are that founder and you are in Silicon Valley, it's the connectivity to capital is different than when you are in Sydney, Australia. I'm sorry, it just is.
Yeah.
You've got 13 or 14 massive firms. I mean, Andreessen Horst just announced they had a $7.4 billion fund that they just raised. I mean, I can't even imagine, right? $7.4 billion. So if you are in the Valley and you have any sort of networking skills, you have a good tech stack and a good business plan, there's a high probability you're going to get some capital. If it's just from Andreessen, it's $7.4 billion. So, capital, we could say, is more abundant.
Yep.
And that whenever there's something abundant, you don't have the stresses, right? Well, I'm gonna grow at all costs. And when I start running out of money, I'll go to my VC partner. They got billions of dollars. They'll give me another, and it just, that's the way it was for a really long time. But when you are you're building outside of that ecosystem, capital is more scarce. And when anything is scarce, you have to be on top of things a little bit more. You have to be more concerned. You have to be more stressed out. If I give you $1 million and you're in Sydney, you have to stretch that $1 million out as long as you can. So there's no room for, sloppiness, right? If you go to a founder's office in Sydney, or in London, or in Stockholm, Sweden, or in Mexico City, and you go into that office, there are no ping pong tables and video games and pool tables, because there's no time for that kind of stuff. If you go to a founder's office in the Valley, the first thing that my partner and I always do is we take a bet. Are they on the right-hand side or the left-hand side of the door? Now, again, that's not to be negative. It's not to, God bless them, right, for being there. But it's different. And I think that because of that, what we found, 15-year bull run, and then all of a sudden, what is it, going on 2 years now, we went into a bear market for the first time in 15 years. Now, someone like me sits down with you as a founder and says, hey, I need you to take, $100,000 out of your monthly burn. That means you've got to fire people that have become your friends. That means, you might not be able to do this and that, and you might have to sell the video games. You might have to downsize your office. It's not fun. There's nothing positive about that. It's all negative stuff. If I say that to someone who has an abundant mindset, that's a really hard thing to accept. If I go to Sydney and I sit down with Fred, my dear friend Fred, and I say, Fred, I need you to take $100,000 out of the burn, he's going to look at me and say, yeah, no problem, mate. Yeah, been there. We can do that. No problem. That's we probably got a little heavy as it is. We need to thin out a little bit, and that's kind of that attitude. And so I think in many ways your founders outside of that ecosystem tend to be better business people because they have to be. And for me, I think that's better for my investors because I'm actually buying down risk by investing in people who are more maybe stronger corporate athletes.
That is such an interesting thesis, and it's really interesting. As you were talking, there's these smiles that come to my face because there's like the parallels in our business, and I'll share. So we had an exit of 180 million, but we were bootstrapped to the end. But we went to go and try and raise capital in the early days. And so to paint you the picture, it's year 5. We've got a platform that we're the second largest in the industry of real estate. We've got $1.5 million recurring revenue. And we tried to raise, and the person went from 20 and slowly dripped us down to a $5 million raise, and they wanted to buy 20%. And we were like, no chance.
Right.
And it's so interesting you say that, because then, I also reflect on, well, because we were bootstrapped and because it was our cash, you do make it go far.
That's right.
You learn how to make, every dollar stretch. And I think that's just like an important takeaway for everybody listening is like, okay, wherever you're located, hearing it from someone like yourself is like understanding the power and the responsibility that you should have with money in your business is a superpower.
It is.
And it's one of my, I almost see a challenge, and it's, something that I need to challenge myself on, but, founders too early, thinking the logical steps of creating a business is, an idea, model, MVP, and then we raise immediately.
Yeah.
And like without ever actually thinking about, well, commercialization, product market fit, I almost think it's better to have a couple of years where you are bootstrapping to learn those principles and practices before you get the injection of money where you now know how to, deploy the capital correctly.
Because you respect it, because you understand that, that you value it more, right? So like I was on a scholarship in college, and then I lost that scholarship just for a number of reasons, health reasons. And then the rest of my college had to be paid for by myself. Well, let me tell you something. My grades were significantly different when I was paying for it myself versus when I was on a scholarship. And the reason for that is because I had to come out of pocket, every quarter to pay that tuition bill. And I was gonna get something out of it, and it's kind of the same thing that you're saying. And I really do believe there's a psychological, fact to that. Again, it's a thesis, but I think over the last 18 months we have created some significant proof source to this thesis, and it's something that we're proud of because. When I started fueling in Miami, Florida in 2017, all my friends from New York thought I had finally lost my mind, right? Because, Miami in 2017 didn't look like this. This was a hospitality, nightlife, real estate play. If I were to pull 10 people on Lincoln Road aside and say, hey, what do you know about venture capital? I'm not even sure that half of them would know how to spell it. So it made no sense what I was doing, but I was responsible for all of the business in Latin America for like 15 years. And so I had real connectivity to Latin America and not only connectivity, but significant appreciation. And it just made sense to me that American companies were going to be wanting to go into Latin America, which is a massive market, to expand market share, expand revenue streams. And then there would be talent coming out of Latin America coming into to America, because what happens is young people get educated and go to university in the United States, but then they go home. So this is an interesting fact. We've got an investor who lives in Belize, and he owns a massive dev shop in Belize. 80% of his revenue comes from Silicon Valley.
Wow.
Now think about that for a minute. So this guy comes to the United States, gets educated, creates this cohort of buddies who are from his, country. They go back home and they build out this incredible dev shop that costs half of what it, costs in Silicon Valley. And now 80% of their business is coming out of the U.S. and Silicon Valley. And that's the kind of stuff that's happening. And because we're in the capital of Latin America here in Miami, listen, for Latin American investors and Latin American portfolio companies and founders, we are the go-to VC, period, in a discussion. And I don't care if we're competing against Andreessen Horowitz or not, because Andreessen's not going to fly to Bogota, Colombia to sit on a board. They're not going to fly, some of them will go into Mexico City now because there's so much opportunity down there. But like I tell all my friends in Mexico City, be careful, right? Because, Latin America does have different culture. And that's why Miami is so damn special. It's really close to the United States, but it's not the United States.
That's awesome. So let me, there was something you mentioned there, which I want to drill into, which is around you guys are really active in the investments you make. And, one of the questions I get asked often is like, where do I go? Who do I choose? What's the right place to raise money? And like the biggest thing I always say is like, the money is one factor, but it's like partnering with the right person is a very big difference between great success and a terrible partnership. And so I'd love to understand, like, what does highly active look like for you?
Yeah, and I think to be fair, right? So, are we we deploy a proprietary investment process, which we call phased investing. And to make that as simple as I can possibly make it, what we believe is the only way to really understand risk, right? If you think about public investing and private investing, public investing, again, it's the abundance and scarcity. Public investing, there's an abundance of information and knowledge that we can get our hands on to do an analysis and make an educated investment decision. Yes?
Yep.
In the private sector, knowledge is scarce. It's not abundant. It takes a network. It takes skill. It takes intellectual firepower to understand it. But the biggest block of knowledge that you can get is time, right? I mean, if I spend every single day with you, I'm going to get to know you really, really well, and I'm going to get to understand and know where you as a leader, where your gaps are, and I'm going to understand where your company's gaps are. And then I can come in, I call it gap analysis. And then I'll come in and say, okay, listen, I don't think you're a very good listener. You need to be a better listener. Or, we need to work on your public speaking skills. Or, your math really sucks, so we need to bring in a good CFO, whatever that is. But you can only get that over time. So what we do, traditional, you said it a few minutes ago, a traditional venture capitalist will come in, sit down with you and say, we want to own 20% of your cap table and we're willing to pay you X for that. And then they write that check and they're done. I just think that is a silly way of investing other people's money in this asset class because of that lack of knowledge.
Yeah.
So what we'll do is we've actually done a bunch of scattergram analysis on rounds, so Series A, Series Bridge to A, C, B, D, and so on. And we will do control factors around capital going in, return on that capital or loss of that capital. If you put that onto a scattergram analysis, you can kind of narrow in these bands. So for example, on a Series A, our band is from $1 million to $5 million. So investing a check for $1 million to $5 million, $5 million obviously being you have a lot of conviction. $1 million being, it's the smarter way to do it. We'll invest $1 million in that first check. Then the agreement between the founders and us is, listen, we're going to be very involved. We're in the sandbox with you. We're going to help really, we call co-build the company. But ultimately, if you get more fuel, is up to you. Because we're going to create KPIs that we're going to measure on a monthly basis. And if you're meeting or exceeding those KPIs, there's always going to be fuel for you at every fuel station that you need it. But if you're not, we'll give you time, energy, mental capacity, but we're not going to give you our investors' capital because we can't.
That's actually really interesting. Do you know what else is interesting? The Eat with Purpose cookbook. It's part of my mission to raise $1 million for charity. This podcast is part of that goal. And what you can do is like, comment, share, and leave us a review. Let's get back to the guest.
That would just be a fiduciary irresponsible, right? So that's how we do that. So at the end of the day, when it's all said and done, and you've constructed the portfolio, which takes longer. Right? Traditional VC will raise money and they'll deploy it in 18 to 24 months. Where we're more like 3, 4, 5 years.
Oh wow!
In total deployment, because and you're giving up a little bit of the margin. But you're managing the downside. And that's, my partner is a former long short hedge fund manager. So we have a lot of risk mitigation theories and tools in our firm that maybe a lot of others don't. And so to get back to your question more concisely, at the end of the day, what that means is in a portfolio of 25, you're going to have 12 to 13 high conviction companies. And what high conviction to us means is that we are continuing to follow along and invest our investors' capital into that company. And those are the companies that are going to get all of our attention, right? And I mean a lot of our attention. I mean, we have companies here in Miami where we have standing meetings every Tuesday morning.
Wow.
And there has to be a damn good reason why that meeting would be pushed or canceled. And we do that a lot, right? But then the other ones that didn't get follow-on, I'm going to be I can't lie to you. There are some portfolio companies we might have invested $500,000 in out of the very beginning, and we never did it again. And I don't have time, and I'm not connected in that company or with that founder hardly in any way. And it's just impossible to do it all. You only have so much bandwidth.
Of course, and that makes sense. And the power that gives those companies in terms of like, if I just even think about like youngish founders, it might be 20 to 30, and then working with yourself and a team who have seen all these different stages and be able to bridge that knowledge gap of time in terms of they might be thinking, here's 5 different ways we're going to go for our strategy, and you're like, well, I've seen 3 of those play out and they don't work. Well, let's focus on these 2. Like you can condense the amount of time for that company to be successful with that knowledge is incredible.
Well, I think it gets back to what really allowed me to be where I'm at, and that's the mentorship. I'll tell you a quick story which touches on what you're saying. I have a portfolio company that's in absolutely world-class technologists in the VR AR world. And they've built the #1 VR multiplayer shooter game on the face of the planet today.
Wow.
I'll give it a shout out. It's called The Veil. And it's an incredible, made by just incredible human beings. And I think it's okay that I say this, but let's just say that the prince of a very large country wanted to meet with us. And so we fly over there. And so before we went, I was like, okay, you guys, my founders had never had a suit on before. My founders had never had dress shoes on before. So we had to go get, a suit, nice shirt, and proper shoes. We get over there, we meet with the prince, and my founders are complaining about how their feet hurt. They just were really uncomfortable. And so the next day, one of my founders, the CEO of the company, is like, Jeff, I'm not going to wear a suit today. I'm just going to be myself. I don't feel comfortable. And I said to him, okay, sit your ass down, right? And just listen to me. I said, every single person who's going to be in that meeting is going to be in a formal attire. Not in a suit and tie like an American, but the formal attire of this country that we're in right now, and we're guests here. Now, you can go in there and be a dipshit, young founder American who doesn't care about other people's, culture, et cetera, and show up looking like you want to look. And there's nothing wrong with that. All I'm simply saying is that you're not aligning yourself to the person. You're basically going and having a meeting with the president of the United States who's going to be in a suit and tie, and you're going to show up, with a pair of Nike shoes on. I mean, you can do that, but you probably shouldn't.
Yeah.
And it was funny because one of the staff members of the prince was in the room when I'm having this coaching session. And he stands up and he says, thank you for saying that. I've never heard anyone in your position talk like that. But the fact that you are thinking that way is going to take this company to a much higher level because you are respecting. And he said, it's true. We're not allowed to be in casual attire any time that we're anywhere around the prince. And so, we showed up in a different way. And the prince actually made comments about it, right? And so those are the little things that you get from, hanging out with an old guy like me because I came from that world, right? I would never show up at Goldman Sachs like I am right now. I mean, I could, but I'm never going to get anywhere because nobody's ever going to take me serious.
It's so interesting. That's like the very intangible. It's like, like the very intangible thing, but it can make a material difference. One of the things we were chatting off before we got onto this in front of the microphones, and I think it's really interesting, kind of taking a step back, is around all of the companies that are building AI today and building just on top of the large language models and things like that. And I want to share with something we didn't talk about, but something that came to my mind. Let's loosely call it my thesis. I almost see like the word AI today is kind of like this big gold rush, and everybody wants to have that in their name and title. They're building these almost like features off the top of your large language models, your ChatGPTs. And I kind of see like in the next 10-year horizon, like the big players, the players who are going to take all, if you're not actually building the fundamental technology that's underneath, they'll go, that's a great feature, we'll just build it in here. Or, or go and spin off their own versions. And I kind of think there's, thousands getting created, but I feel like in the next 10 years, like of that, there'll be like 5% left that will thrive. You can correct me if you think I'm wrong, but I'm curious to know your thoughts.
I would say that your thesis and my thesis are perfectly aligned with one element in difference, and I don't think it's going to be 10 years.
Yeah.
First of all, I don't think anything anymore has a 10-year span. I think that I think that in the next 5 years, we are going to move more space as far as technological advancements than we did in the last 30 years. And I firmly believe that with quantum computing and where AI is right now, in 5 years, we're going to look around and we're not going to recognize most anything that's there. I really believe that. So that's the only thing that we're different on. And I think that you're absolutely correct. And I think, as with most things, the human condition, it's interesting, especially investor psychology, which I've been studying my entire life. And that is that the investor tends to only feel comfortable when they're surrounded by everybody else, right? They do not like being in the desert by themselves. It scares the living hell out of them. And so if you go into a bear market, they'll hunker down and they won't come out of their bunkers until they start seeing bulls running across the pasture. And I think that they need to be really careful with that. It's that fear of missing out, number one. And it's this chasing momentum. And you're absolutely correct. I mean, I know that there are founders because I've met with them. We've been really working very hard to identify an AI company that really met our investment thesis. We've looked at a couple hundred in the last couple of months. And I've met with founders who literally will have, .ai, or they'll say that they're an AI, and when you really start getting under the hood, there's nothing really AI about the company, but because it's there, they're able to raise some capital.
It's almost like the dot-com boom.
Well, it is, and again, I'm aging myself, and I can't stand doing that, but I was a dot-com analyst for God's sakes, so I've seen this crap before, and it's very, very prevalent, and you're absolutely correct, by the way. If you think about the big players in this space right now, they've got more money than Moses. And all they have to do is be patient and let the creative economy pop up ideas. Oh, I like that. And just go do it. There's no moat around that. When you're a giant, you can kind of do whatever you want to do. And so I think to your point, if you're not creating proprietary technology where it's yours, I don't know why anyone would invest in that. And I've shared this with you in the past, but we made an investment early in the fund in 2018 in a company that was leveraging data from Meta. And at that time, the data sat on the outside of the paywall. And you could scrape that information, and they would scrape that information, and it drove this business, which was really a cool business. It's really unfortunate. But Meta made a decision one day. Yeah, we're not going to do that anymore because we have so many people that are concerned about the data that we have. And so if we're letting that data that we own, out to other people, and we don't know how that they're controlling it or doing it or leveraging it, then we have ownership there. Okay, it's time to put it on the other side of the paywall. And the company was gone within 24 hours.
What was the scale there? Like, $1 million revenue, was it? I'm just trying to understand that scale of collapse overnight.
This was a company that was doing over $3 million in ARR.
Wow.
And it actually had potential acquirers. We thought we were selling the company within like a 6-month period of time. It was a really cool company. Really cool company. But it depended on another company's bones. And as a result, it just died. And so I think with AI, you have to be very thoughtful about that, right? If you're now, you look at fintech. So it's interesting, right? A lot of people will say to me, well, are the big banks going to go away? And I always say no. It's going to continue to consolidate, but your big banks are going to remain there because they created the rails that all of us as fintech investors are building businesses on. But we need those rails. And so with AI, what we're trying to determine is what are rails, right, that can be built upon, and those rails remain there for centuries. And what is something that is really more proprietary, and it's a train that can be pulled back into the station at any time. And I think that's the trick right now. And how we've chosen to invest in it is try to identify founders who are kind of doing AI long before it became the in thing to do. Like we're investing in this YBot company out of Sydney, and they were talking about AI 5 years ago. And they have their own technology, and that's what we're interested in. That's what we think is a safe investment to get our investors into the AI vertical. and be smart about it.
And the overlay I want to also share for the audience is, sometimes when we have these conversations, people will sometimes go, well, that's not contextual to me because I'm not in that company. But the principle and the lesson that you've just shared there is so relevant to so many companies, which is being beholden to one thing that if it breaks in your business, is that the business is over. So whether that be succession planning with leaders in your business, whether it be, you only have one marketing channel, you've been only focusing on, Instagram and you're on the creative economy and you haven't, pivoted into TikTok and YouTube, well, something can change there. And so just making sure you have those fail safes in your business so that not one thing can fundamentally, stop your business in its tracks.
Yeah. And, those are called ripple effects, right? And again, when we're young in our life cycle, we don't think about the ripple effects, but it's really, really important to do so. We talked about the suit, for example. I say, if you ask anybody on my team, I say it almost every day, but everything matters. And it's usually the little tiny details that are more important than anything else. Like this morning, we had an investor call, and it's how does the room look? Is your background blurred? Are we not going to blur it? It drives people absolutely crazy because I have OCD around little tiny things. In fact, I've had team members say to me, why are you always so focused on these little things and not the big things? And I'm like, the big things get done. It's the little things that don't get done and then will end up affecting you. So you're absolutely correct. You talk about, how deep is your firm? If you get hit by a car and you can't come to work for 3 months, what happens to the company, right? So like in this firm, if something happens to me, this firm can go on because of Maggie, my partner. If something happened to Maggie, it would be harder for me to actually replace her than it would for her to replace me. But, we talk about those things. And as a result, if we have to fly somewhere, she'll take a different flight than I will.
Wow.
Because we have a responsibility to our investors. We both can't go down.
Incredible.
Right? So those are things that are minor, that most people don't think through, but it's a really important ripple effect. And it's probably, again, I've been around for a while. But, I was there at 9/11. When I went to work that morning, I wasn't thinking that 2 planes were going to, fly into the building across the street from me. But I went through that. Right?
Across the street.
Wow. So it's like when you experience, and that's really what life cycle is all about. It's about wisdom. It truly, truly is. So if you're a young person, I think the best thing that you can do is try to find a couple of people that you admire, that, maybe they just have a way about them, a swagger about them, that you like how they dress, you like how they present themselves, you like the car they drive. You just want to be more like that person. You've got to figure out a way to get that person to put their arm around you, because that you're going to ultimately, at the end of the day, you become a part of that bloodline. And let me tell you something, that person that you admire didn't get where that person is without somebody else who put their arm around him or her. And that's really how it works. It's that bloodline and what you learn, because you pick up everything that they did. You don't have to make those mistakes. And then you're actually, catapulting forward. And that's really what the whole thing is all about.
Amazing. I have one last question for you, Jeff. As you reflect on the career and the life you've had and the businesses you've created, what do you think you're most proud of?
Yeah, I am most proud of the people that I've helped see in themselves what they didn't see in themselves. Believe it or not, to this day, I get emails from people that I helped that just say thank you, right? If it weren't for you, I wouldn't have what I have. I wouldn't be where I am. I wouldn't have met my wife. I wouldn't, And to me, those are the things that are my legacy, right? I mean, at the end of the day, are people going to remember me for the car I drove or the yacht that I had or, the watch that I wore? No. But when I'm long gone, it's going to be the stories of the people that I saw in them something that they couldn't see in themselves, and I helped them develop it, and they become very, very successful. I'm really proud of making. I've made a lot of people millionaires, and I'm very proud of that.
That's awesome, Jeff. Thank you so much for your time today. It's been amazing.
Thank you, my friend.